Hello everyone, welcome to chapter 25. In this chapter, we'll be talking about narrative, what it is, what's its impact on our analysis, how to actually build narrative, and what's the difference between time and price-based narrative. We'll be going over all of those things in this chapter, and by the end of it, you'll know exactly how to build a proper narrative and how to actually integrate it with the rest of your analysis. So, without wasting any time, let's get in the chapter. All right, let's break down what narrative is and why it's such a critical and important concept. First of all, let's start off with the introduction, the definition, and why does it matter in the first place, right? So, a narrative is basically the story that price tells over time, and it basically helps you understand the interactions that are happening in the market, right? It's not just about isolated price action, it's about connecting every single move into a cohesive structure to form a clear bias, a clear directional bias on how price will reach the drawn liquidity, right? That's the story that narrative tells us. Think of it like piecing together a puzzle, right? Each price movement that you see, each reaction at a key level that happens, and every single market behavior adds another piece to the overall story. The goal for us is to understand where the market is headed and at which time it is headed and why it is headed towards that particular liquidity pool or liquidity zone, right? These are the questions that we have to answer through narrative. And narrative provides you with clarity and direction. It cuts through all of the noise of random price movements and it basically allows you to trade with confidence. Now let's talk about why does narrative matter in the first place. The reason narrative matters is because a strong narratives answer three key questions about price behavior in market movements. Now, the number one and the most important question that it answers is that how will price reach the drawn liquidity, right? Narratives basically helps you understand the path that is price likely going to take in order to reach the drawn liquidity. For example, will it create a manipulation profile or a manipulation leg before expanding towards the liquidity target of the drawn liquidity? Will it respect a dealing range or any other key levels along the way? And basically, uh, whether it's going to form a retracement profile before expanding towards return liquidity, right? These are different questions that narratives will help you dissect and understand. So that way you can make much more informed decisions about how price is going to reach the drawn liquidity. And without proper narrative, you wouldn't know in which market profile is the market currently behaving or moving, what sort of market profiles are we going to form next and what to actually anticipate, right? These are the things that narrative helps you with. And knowing how price is likely to move basically provides you with the framework for your setups, right? And it allows you to position yourself correctly and accordingly to the market structure and price behavior in movements. The number two question it answers is that why is price likely to move towards the turn liquidity, right? That's a question that we ask ourselves, right? And narratives basically helps us answer that. Narratives explain the reasoning behind market behavior. Is the market targeting liquidity pools above swing highs or swing lows, and are institution driving price to collect liquidity before making a significant move? These are some questions that we have about price and market behavior, and narratives helps us answer and dissect those questions. Basically, understanding why price is moving gives you confidence in your buys, and it ensures that your trades and your trade ideas and setups are aligned with the broader market forces. The third question is that when is price expected to reach the drawn liquidity, right? We know that timing is extremely critical and important in trading, right? And narratives provides clarity on the when aspect of the charts. Is price likely to reach the target during the London or the New York zone or any other key macro? Does the market needs to consolidate first before making its move? And you know that based on the different times of the day you can have different market profiles more often than not. For example, during Asian session we're going to have uh, an Asian range more often than not, and then in London kill zone based on the high time frame order flow, drawn liquidity, and key levels we can either have a delayed protraction or a normal protraction. And those are basically intraday profiles which are a key, which is a key concept that is used to build a time-based narrative, right? Which basically helps us understand the question of when the question that is when is price expected to reach return liquidity. And by answering these questions, narratives helps you avoid unnecessary trades and helps you focus on only the high probability windows of opportunity during the day. So what you need to remember is that narrative is the big picture, right? It's the story that price tells and connects all the small moves into a cohesive framework. Narratives provides direction, right? It explains how, why, and when price is likely to move towards return liquidity. And last but not least, narrative helps you gain clarity in your trades, right? With a strong narrative, you are no longer reacting blindly to price. You are trading with intention and you have a clear understanding of what the market story is and how you're going to capitalize and exploit that story in your own favor. That's what narrative helps you with. Now let's move on to the next slide and let's talk about the importance of narrative and what different things it is going to help you with. A well defined narrative is the backbone of an accurate market analysis. It answers your most pressing question about price behavior, key levels, timing, and market participation, and all of that together allows you to trade with confidence and clarity. Now, when I say narrative, I'm actually talking about the story that price tells over time and the framework that helps you answer some of the most critical questions in your analysis. And right here, you can see some of those important questions. The number one question is that which key level to choose and why that particular key level is significant. A narrative basically guides you in identifying and selecting the correct key levels that align with the current high time frame market story and market context. For example, if the market is trying towards the high time frame liquidity pool, the narrative will help you highlight why a specific daily or 4 hour key level such as an R block or breaker or an FEG is critical and how you can use that key level to position yourself to exploit the range expansion that is about to occur. And the reason it's important is because if you're choosing random key levels without understanding their role in the bigger picture, you're just guessing, right? And narrative eliminates that guesswork by giving you actual context that you can exploit by using an edge that gives you a statistical favor in the long term. The second question is that which candle ranges or CRT to choose and select and why it fits the current structure, right? Narrative helps you explain which CRT are relevant based on the current market context and exactly which candle ranges to choose to position ourselves in the direction of the higher time frame drawn liquidity. The third question is that when do you wait for a liquidity purge or when a liquidity purge or a manipulation profile is going to happen, right? Narrative tells you when patience is necessary and when you should actually participate, right? And engage with the market. For example, if price is consolidating near a key level, right, then narrative might signal to you that a liquidity purge is likely before the true move happens, right? So instead of you trying to enter that position early, what you're going to do is you're going to wait for a liquidity purge or a manipulation profile to happen, right? And then you're going to enter, which will help you avoid entering that position prematurely, right? Because you waited for the market to grab liquidity, manipulate traders, and then reverse from there. And only then you're going to position yourself in that expansion or that range expansion, right? And this is exactly how turtle soup setups are born. Now, the reason this is important is because jumping the gun can cost you money and confidence, and narrative teaches you when to stay patient, right? And when to participate with the market when it reveals you its hand. Now, another critical question that narrative answers is that should you even be trading right now, or should you even be looking for setups right now, right? And let's be honest, not every market condition is worth your time. Narrative provides clarity on when to engage and when to step aside. If the market is choppy and it lacks a clear directional bias or drawn liquidity, or it's moving unpredictably, then narrative might suggest you to stay out and stay risk off. But on the other side, if the story is clear in prices aligning with key levels correctly, and there is a clear higher time frame candle range in liquidity target, then that's your cue to act. And the reason this is important is because knowing when not to trade is just as important as knowing when to trade, right? Avoiding bad trades not only protects your capital but also keeps you mentally focused and confident. And then finally, narrative helps you integrate all these pieces together into a structured buys. It ties together high time frame key levels, candle ranges, timing, and liquidity behavior into a cohesive story. And this story basically answers the how, why, and the when aspects of the charts and price movements. And essentially, it gives you a framework to approach the market with an objective and mechanical approach. For example, the narrative might tell you that the market is drawing towards a daily high or a daily swing low, meaning the higher time frame drawn liquidity. And then based on the 4 hour time frame, you can select a candle range based on your narrative and then position yourself around that candle range on the lower time frame during a key time to capitalize on that range expansion. And you can see that this structured buys eliminates guesswork, and you're no longer trading based on hope. Instead, you are trading with a plan that actually aligns with the market's true intention. So the key takeaway is that a well-constructed narrative is your guide to make informed and intentional trading decisions, right? It answers the most critical questions such as which key levels, which candle ranges, when to wait for a setup, when to act, right? And when to take a step back. All of these questions, and basically it ties together everything together into a cohesive framework. Now, moving on to the next slide. Now that we've discussed in detail what narrative is and why it's so important, let's now talk about the different types of narrative and with the help of which particular concepts are they built. So we've got two different key types of narrative. We've got time-based narrative and price-based narrative. Let's first of all discuss time-based narrative in all of its details. So let's start off with the introduction to time-based narrative. A time-based narrative uses time concepts, right? Time concepts of the charts, such as weekly profiles, intraday profiles, and the orientation of the Asian range to form a structured bias, right? It's not just about what price is doing, but when it is doing it and why that matters, right? And by anchoring your analysis to specific time frames, you can better predict market behavior and position yourself with clarity and precision, right? At its core, this approach addresses three big questions. Why is price moving in a certain way? How will it reach its target? And then, third of all, when is the most likely time for a significant move to happen, right? These are the questions that a time based narrative answers. Now, let's explore each of the components in detail. First of all, we've got weekly profiles. We know that the market moves in market profiles and cycles, right? We've got a rhythm of an accumulation, manipulation, and distribution profiles, right? And a weekly profile basically helps you map out these profiles on the weekly range, each one having and each day having its own characteristics, right? It basically helps you map out this process. We know that Monday often establishes the candle range or creates or accumulates liquidity, and then Tuesday and Wednesday they tend to often create the high or the low of the week, right? And then expands on the Monday's range after taking out liquidity, and then Thursday could act as a continuation or a reversal based on the higher time frame order flow and key levels. If you've reached the higher time frame objective, then Thursday could act as a reversal. If not, Thursday can be a continuation, and then Friday can either have a reset day, meaning if it has reached the higher time frame objective, then Friday is basically going to be a consolidation day, and if not, we can still expand or continue the weekly range even more until we reach the higher time frame weekly objective. These are the characteristics of each day, depending upon the order flow, key levels, candle ranges, and dealing ranges, right? And weekly profiles basically helps us map out this whole process on the weekly range and on different days of the week. And one important thing about this weekly profile narrative is that it shifts throughout the week. As the week progresses, the narrative actually evolves because the market structure changes after each day, and then you have to look at the new market conditions and then make informed decisions based off of those structure and those new frameworks that price might have formed. For example, if the market is building liquidity on Monday and Tuesday, then the narrative might indicate a manipulation profile or a manipulation move midweek on Wednesday, in which price forms the high of the week on Wednesday, and then the rest of the week on Thursday and Friday, price expands lower, right, and basically has the weekly range expansion. And then what you can do is you can capitalize on that weekly range expansion by positioning yourself on Wednesday instead of Monday and Tuesday. Now, next up, the next concept that we've got is intraday profiles. Now, just like weekly profiles dissect the weekly candle, intraday profile helps us dissect and understand the daily candle and the range expansions occurring within a single trading day. When we zoom in, intraday profile focuses on the daily narrative and how price interacts with session specific levels and session specific events that are occurring. If you've gone through the intraday profile chapter, then you would know that each trading session or kill zone has its own story to tell, right? The London kill zone or session is known for its expansion phase, where a price often manipulates liquidity before making the range expansion. And the New Year session typically offers continuation or reversals of London's move based on key levels and dealing ranges in premium and discount zones. And then London close kill zone and Asian range in CBDR has their own session specific characteristics, and you need to be aware of all of those characteristics. And not only that, but you also must be equipped with enough knowledge so that you can properly integrate them with the higher time frame market context and framework and structure, so that you can make much more informed decisions and uh, and generate trading ideas based off of those structure and frameworks, and decide whether you want to trade or not and how you're going to manage risk in those sort of scenarios. The reason it's so important is because intraday profiles allows you to tailor your trades to the session's dynamics, which ensures you are trading in sync and in line with the market's rhythm. And then we've got the Asian range orientation, or the orientation of the Asian range. We know that more often than not, the Asian session is a ranging profile or a consolidation profile, basically it acts as a reference point for us for the rest of the day and guides us to where manipulation profile could happen, or where expansion could play out. We can have different combinations in different scenarios. For example, let's say the drawn liquidity is lower and the Asian range forms just below a 4 hour key level, and then during London sessions, our main objective would be to wait for price to take out the Asian range liquidity, and also along with that test the 4 hour premium key level before we could expand lower, right? That's what we call building narrative, because we've concluded the price is going to first of all take out liquidity before moving lower. And the reason for that is because the market makers always make sure to take out retail traders in liquidity before it can have the actual real expansions, and it makes sure that it only does that expansion alone and takes out all the retail traders right before it happens. We can then have different scenarios in combination based on the orientation of the Asian range, based on where we are in the overall higher time frame market structure in context, and based on the open high low close concept, right? We can have different scenarios, and you need to be able to properly identify and then integrate it with your analysis and make informed decisions based off of that, right? Time-based narrative is about connecting the dots between price action and time, whether it's the weekly cycle, the daily session, or the Asian range. When you master this approach, you're not just reacting to the market, you are predicting its next move with clarity and confidence by actually timing it and answering the questions about the key time aspects of the charts. Moving on to the next slide. Next up, we've got is price based narrative. Now, this is just as important as time based narrative. And further into the video, we're going to be discussing how to actually integrate both types of narratives with each other to form a even more logical and cohesive story. Using each type of narrative alone makes them redundant, and the only way they serve any purpose in our analysis is when they are integrated logically with each other under the right circumstances and frameworks. So let's start and let's discuss price based narrative in detail. So, first of all, let's answer the question that is, what is a price based narrative? Now, a price based narrative utilizes key price concepts such as the open high low close concept, market maker models, power of three to explain how and why the market moves the way it does. Right? It focuses on open high low close levels, relative highs and lows, and liquidity pools, and concepts such as the market maker models or the power of three answer the how and the why questions of the market. The purpose of a price-based narrative is to piece together price movements into a logical story, which essentially gives you clarity to make informed trading decisions. Now, by understanding the price-based narrative, you can anticipate where the market is likely to go and why is it likely going there. Right? These are the questions that a price-based narrative will answer for you. Now, let's break it down. First of all, we've got the open high low close concept. The open high low close concept basically acts as a objective tool for you to define your anchor points during the day, right? The open high low close level uh, work both on the daily and the weekly candle, right? And they are basically the foundation of price based narrative. And you know that these levels act as a key reference point for price action and provide structure to the daily candle or the weekly candle's market behavior. Now, the reason the open high low close levels are so important is because, first of all, they act as anchor points for both intraday and swing trading. It helps you determine whether the market is trending, consolidating, or reversing, or whether it's overbought or oversold, right? For example, if the drawn liquidity is lower and the daily candle opens, right, then in that case, our objective is going to be to sell above the daily open or the weekly open. And in terms of a bullish scenario or bullish market conditions, our objective would be to buy below the daily or the weekly open. For example, if price stays above the daily open, it suggests that we have bullish momentum, and below the daily open, we have bearish momentum. You can watch the open high low close chapter that I've made about it, and basically that would help you understand this concept even more, and then you're going to be equipped with enough knowledge about using this concept and actually approaching it the right way. The second concept you'll be using to form a price based narrative is answering the question of how liquidity forms and how liquidity acts as anchor points for you. First of all, let's answer what are liquidity pools. Liquidity pools are cluster of stop losses or stop loss orders placed by retail traders above highs or below swing lows. And these liquidity pools basically acts as magnets for price in and institutional money or the market maker target those stop losses and target those liquidity for their large orders. Now, the way this concept fits the narrative is because we know that price often manipulates these highs and lows before making the actual real expansion and range expansion. For example, if price sweeps a daily high during the London kill zone and then sharply reverses, then it's a sign that liquidity has been grabbed and the market is ready to move in the opposite direction. The way how you're going to use these liquidity pools to build narrative is by using it in conjunction with key levels and dealing ranges, right? And then combine them with each other in a logical manner and then make a logical story about how price is going to react and how price is going to actually play out based on these reference points. The next concept that you would be using is the power of three, Or you could also call it the AMD concept or the accumulation, manipulation, and distribution concept. The power of three is a key concept for dissecting market behavior. It's basically an advanced version of market profiles. You know that in market profiles we've got five different types of market profiles, and basically the power of three has narrowed those profiles down to just three, which are the accumulation, manipulation, and distribution profiles. It explains how price moves through these three distinct phases. The phases of power 3 are the accumulation, where price consolidates and builds and generates liquidity. A common example of the accumulation phase is the Asian range or CBDR. Then we've got the manipulation phase or the manipulation profile. This phase involves a liquidity grab or a manipulation hunt. Price manipulates above the accumulation that we formed earlier. In this case, a common example would be the London kill zone. It acts as a manipulation profile. So the Asian range acts as an accumulation profile where it generates liquidity. Then London takes out that liquidity and purchases it, which is the manipulation profile. And then last but not least, we have the distribution profile in which the actual expansion happens. What happens after manipulation profile is that price expands in the true direction and starts moving towards the higher time frame drawn liquidity. Now let's talk about how to use power of three in building a narrative. So the three steps are first of all, identify the consolidation phase or the accumulation phase, right? Then watch for price to manipulate above or below that consolidation or accumulation phase based on higher time frame drawn liquidity, and then position yourself in the distribution phase after the manipulation happens and price is confirmed to go in the opposite direction, and that way you've built a proper narrative with the help of power of 3. Now, understanding power of 3 helps you anticipate not just where price is going, but how it's likely to get there. Price-based narrative is basically your roadmap to understanding how the market behaves, and by focusing on the open, high, low, close levels, liquidity pools, and power of 3, in including dealing ranges and PDRs, you can form a structured bias and trade with confidence. Moving on to the next slide. In this slide, we're going to talk about an advanced yet essential concept in trading, which is combining time-based and price-based narrative with each other in a logical and an objective approach. Now, while these narratives can work individually, their real power emerges when they are combined with each other to form a more cleaner and broader picture of the market. Let's explore how this integration works and why it's so important. Basically, what we are doing is we are merging time and price for a clearer picture. First of all, let's start with the basics. Time-based narrative focuses on when price is likely to move and how it interacts with specific market phases or liquidity dynamics at key times. For example, weekly profiles help dissect the weekly candle and weekly range expansion. Intraday profile helps dissect the daily candle, right? And then we've got kill zones like the London kill zone, New York kill zone, which have their own distinct characteristics and different conclusions or results based on the frameworks that we are dealing with. And then price based narrative, on the other hand, focuses on where price is relative to critical levels like open, high, low, close levels and liquidity pools, key PDRAs or dealing ranges, and so on. And when both of these narratives are combined, they help provide both the timing and the context for high probability setups. In short, they answer the when aspects of the chart, the where, and the why aspects of the chart. For example, when is the market likely to move? Where is price likely to go, and what levels are significant? And why is this combination necessary? All of these questions are answered by your narrative, both your time based narrative and price based narrative. We know that trading isn't just about knowing where price might go, it's also about understanding when it's most likely to make that move so that you can then position yourself correctly at the correct time instead of positioning yourself at a wrong time, which would lead you to losses instead of actually capitalizing on the move. Now, let's talk about why we should combine time and price based narratives. Let's dive into the benefits of merging these two narratives. First of all, combining time and price based narrative gives you a more complete view of the market. Time narrative provide the overall rhythm of the market, while price narrative pinpoint specific key levels that matter. For example, a time-based narrative might tell you that the London kill zone is a high probability period for price manipulation and expansions to occur, and on the other hand, a price narrative would identify the exact key levels for you, like order blocks or for our candle ranges, where these manipulation profile could happen, and then together they both allow you to anticipate not just what the market will do, but when and where it's likely to happen, and then you can accurately position yourself to capitalize on the move. Number two, it helps you understand the market's rhythm and levels, right? When liquidity is likely to shift and when significant moves are expected to happen. For example, the London Open is known for manipulation profile, while in New York often continues or reverses that trend. And then we've got the price-based narrative, right, which provides you with the precision and helps you focus on key levels like uh, order blocks, fair value gaps, breakers, liquidity pools, or standard deviations. Number three, it helps you identify high probability setups. Now, the true power of merging these narratives lies in their ability to help you spot high probability setups and also help you avoid low probability setups at the same time. A practical example would be, let's say you are trading the London kill zone, and then the way how time-based narrative will help you is that it will tell you that the London session often begins with a manipulation phase, grabbing liquidity before expanding in the true direction. And a price-based narrative will tell you that the daily low often forms at the 2 or 2.5 standard deviation of the Asian range, right? And after that low or high is formed, price then expands in the direction of the higher time frame drawn liquidity. And by combining these insights with each other, you can anticipate that during the London kill zone, price will likely manipulate above or below the Asian range before expanding in the direction of the higher time frame down liquidity. And you'll wait for a confirmation before entering. And that way, you'll ensure that your trade aligns with both the time and price context. Moving on to the next slide. Now that we've covered the concepts of time and price based narrative, let's dive into to the practical application on how to actually combine these two methods to create a clear, practical, and an actionable trading framework. This is going to be a step by step approach which will help you integrate the broader market rhythm with precise level and timings, which will give you an edge in identifying high probability setups. The first step is that you're going to assess the weekly profile. The first step is to zoom out and understand the weekly market context. You're going to ask yourself questions such as: is the market currently above or below the weekly open? Where has the market made significant movements in the past few days? Has it entered an accumulation or a manipulation or distribution phase? And the reason these questions are so important is because by understanding the weekly profile, it sets the stage for your trading decisions. It gives you the bigger picture and it helps you align your daily and intraday trades with the overall market narrative on the higher time frame. So once you have your weekly context, the next step is to zoom into the daily open high low close and look and see are there any significant key levels or liquidity pools that aligns with the weekly context. And you're going to answer these questions with intraday profiles, Asian range orientation, 4 hour key levels, candle ranges, and dealing ranges. And then the final step is to find confluences between the time and price based narrative. And this is where the actual magic happens, right? Combining the when from the time narrative and the where from the price narrative, it helps you understand the overall market context and the framework that we are dealing with. Now let's discuss some few practical examples based on this. Let's say you've determined your drawn liquidity on the higher time frame and it's lower. Your directional bias is bearish. Let's say today is Wednesday, and by analyzing the previous day's price action, you've seen that Monday was basically a range or a candle range, and it formed a ranging profile just below a premium daily or weekly key level. And that key level could be in the form of either a breaker block, an order block, or fair value gap. It doesn't matter. The fact of the matter is that it's a higher time frame key level. Then what happened is that price on Tuesday had a manipulation profile, and it took out the Monday's candle range and tested the premium key level, and then it closed lower. So now based on weekly profile, we've built this narrative that price formed the high of the week on Tuesday at the premium key level, and now the rest of the week we can have weekly range expansion lower. That means that now we can look for shorts on the lower time frame on Wednesday, but obviously we cannot short straight away, right? We need an anchor point where we can structure our entry based on a reference, right? And then we can set your stop loss and take profits in a mechanical and objective manner before taking an entry. And that's where we're going to analyze the daily candle with open high low close concept, and then look for any 4 hour key levels to see where we are in the whole broader framework and market context, right? And then along with that, we'll also look at the intraday Asian range orientation, right? And then we're going to assess what's happening on the intraday level. And let's say the Asian session formed a ranging profile, meaning an Asian range has been formed. Now, based on that orientation, we see that by marking out the standard deviation of the Asian range, we have a 4 hour key level that perfectly aligns with the standard deviation zones of 2 and 2.5 of the Asian range. So now based on this time and price based narrative, we've came to this conclusion that we're not gonna anticipate anything until and unless price has a manipulation profile, right? But not just some random manipulation profile, but a manipulation profile during London open kill zone, right? And more preferably during the 3 a.m. Key macro, and where it tests the 4 hour key level and tests the two standard deviation level of the Asian range profile. And then once we see a confirmation either in the form of a CSD or an order block, we're going to enter there and take an entry and put our stop loss based on the guidelines and protocols that we've set for our entry models. So right here you can see that we built this narrative that price first had to form a manipulation profile before we could participate. And once price actually formed the manipulation profile and we tested the 4 hour key level, with that price formed the low of the day there, meaning based on the intraday profile, we determined the price from the low of the day there, and then for the rest of the day we could have a daily range expansion higher, right? So we can then look for London or New York continuation higher until we reach or test an opposing premium key level. This is how you form a narrative. Now I know it's a bit long, but you gotta do what's gotta be done, right? And what needs to be done. So make sure to actually practice it live and make narratives on different pairs and instruments, and make sure that you are approaching it correctly. Moving on to the next slide. In this slide, we're going to tackle the realistic side of trading, what it actually truly takes to apply these concepts in live markets. It's not just about the theory, it's about navigating the complexity of real trading scenarios, solving problems, and developing a process that works for you. Now let's dive in. Now, one of the most significant thing that you must always remember is that trading or making a narrative is not a one size fits all game, right? Each trade that you take might need a different and a unique narrative, and you might have to approach each trade differently with a unique and different approach. And now, what I mean by that is that every day you will encounter different questions and puzzles that would need solving. We're going to have different market conditions, different key levels, liquidity zones, and different timing factors that would consistently and constantly change every single day. And you must adapt your narrative to those different conditions and solve them, right? The key point is that the market never repeats itself exactly. So you need to build a unique narrative for each trade tailored to the current conditions. There are countless combinations of concepts and scenarios you need to handle in live markets. And the key to managing all of that complexity lies in a structured learning process, right? The first step is to master each concept separately. focus on learning one concept at a time, whether it's time-based concepts or price-based concept, right? You need to focus on mastering them separately first of all, right? You're going to take your time to study each concept from reliable sources, and you're going to ensure that you fully understand its purpose and application. The second step is to integrate these concepts one by one with each other, right? Once you've mastered the individual concept, start combining them logically in live markets one by one, not all together, right? Because that would lead you to just miserable losses. Instead, you need to start slow and steady and start combining them logically in live markets one by one, right? And then the third step is that confront real market scenarios. The best way to learn is by facing different market conditions and different market situations directly. Each trade you analyze or each trade that you take adds to your experience, and it teaches you how to handle unexpected outcomes and teaches you how to adapt to the new patterns and new market conditions, right? It's about repetition and experience. The truth is that you cannot master trading by simply watching videos or reading about strategies or systems. The practical application of combining time-based and price-based narrative comes from repetition and experience. Now, the way how it will look like is that you'll need to analyze and trade across hundreds of charts over months and years. And this repetition will help you identify patterns, refine your buys, and will help you gain confidence in your decision making process, right? And you're going to make sure that you're going to face every possible scenarios. You'll encounter days when everything aligns perfectly, and then you'll also encounter days when nothing makes sense, and you have to make sure that you approach each day accordingly with the correct approach. The key is to learn from both the winning and the losing outcomes and use each experience to sharpen your process. And also, you need a pragmatic and a realistic mindset, right? Trading isn't about trying to find a shortcut or a magical formula. It's about putting in the work, learning, observing, and adapting over time according to the market's condition. And what you also need to understand is that you need to make sure to put this in your mind that mastery doesn't happen overnight. It happens with consistent efforts, and each day in the market, you have to build your skill set and strengthen your ability by actually approaching the live markets, right? And actually experiencing live trades, and only then it'll help you form accurate and practical narratives. And remember that each trade that you take is a puzzle, and the only way to solve it is by building experience and building one piece at a time. So embrace the process, stay curious, and let the market teach you everything you need to know. Moving on. Now I could give you tons of example here in this video, but it's just gonna unnecessarily make it longer because I've already made tens of breakdowns on euro dollar, and they are in the main CPI group. And if you want to see practical examples of me integrating time and price based narrative with each other, then go over all of those breakdowns, and not just once but multiple times. Those trade breakdowns are the best source for you to understand the practical application of building narrative. So make sure to watch those breakdowns, and even if you've gone through them, go over them again because it'll definitely be worth the time.